All right. Welcome, everybody. Today is September the 1st, start of a new month. Had a really ugly kickoff to this month in the markets. I'm going to cover something a little bit bigger picture today, and I'm going to share with you a concept known as the 4 stages of the stock cycle. Now, this work is not mine.
Right.
Okay, this was originally done by a man named Richard Wyckoff back in the 1930s.
Had a really ugly kickoff to,
and his work has been used and modified and grown since then, but really a visionary of his time. And he was kind of the first to break this cycle loose and to show people the inner workings of the stock market and how the big institutions, the big funds, the mutual funds, the endowments, those multi-billion-dollar funds, how they actually move, manipulate the market, and more than manipulate, just how they operate in the market and how you can identify their actions and ride them to be on the right side of the market. So what you're looking at here, I've got it drawn out for you. This is a weekly chart of Roku stock, ticker symbol ROKU. And I've just got in boxes here the 4 stages of the stock cycle, which we're going to walk through really quickly. A couple of things to know going into this. First of all, you have to understand that stocks, like anything else, operate on the basic premise of supply and demand. All right. I don't care if you're offering shares of stock for sale, or if you're selling iPhones, or if you own a boutique and you're selling $300 jeans, you want to own quality merchandise that is in demand. If there's more demand, meaning people want to buy it, than there is supply, if you wanted to sell it, it's going to go down. If there's more supply, i.e. sellers, than there is demand or buyers, it's going to go up. There's more demand. If there's more supply, it's going to go down. So I tell you that to know that institutions are the big fish in the market. They're wielding billions of dollars. They're buying tens of millions of shares in a stock, accumulating large positions. And it takes them weeks and months to build those positions. So, for example, Warren Buffett this year, first half of this year, has been building a large position in Occidental Petroleum, OXY. It's why the stock has held up better than almost any other oil stock out there, because he's been steadily buying it for months and months and months. So what we're looking to do is identify when those big investors, when the funds are building positions in stock, and when you have the best probability of making money. So let's just walk through the 4 stages. Every stock, especially growth stocks, is going to go through these 4 stages on repeat for the life of that stock. And you can go back, once you kind of learn to spot these, you can go back and look at Apple and Google and Amazon and Roku and anything else, and you'll see this pattern repeat. In this case, it played out over about 2 years here, sometimes maybe 5 or 6 years. But you always want to be cognizant of where a stock is in its life cycle, because this is just knowing this and knowing which of these stages to buy in can dramatically improve your results as a trader and investor. So let's start at the beginning. Stocks begin in stage 1. This is where institutions begin accumulating and building a position in the stocks. They'll spend weeks, they'll spend months doing this. Generally, it's after the stock has come down from a large decline. In fact, if we go back here on the chart of Roku, I didn't look like much here, but you can see this was after the big COVID dip here in 2020, went from 180 down to 60, gets eviscerated, and then begins going through its stages here. So the first stage will often be after a stock has come down large. If you go look at what's happened this year with Netflix and Disney and PayPal and a lot of the others, they're going to finish their stage 4 and go into a new stage 1. This is where the value investors kind of come in. The stock looks cheap based on price to earnings, whatever metric they're looking at. They begin building positions. Stage 2 is where things really start getting exciting. And this is where you're going to make 98% of your money as a stock trader, is in stage 2. In fact, I only buy stocks that are in stage 2. For the sheer reason that the odds are the best that you're going to have a successful outcome here. So as the stock breaks out of that first stage, you're going to see demand increase for the stock. Generally, something has happened at this company with something like Crocs. Remember that thing, the ugly but comfortable shoes that came out in like 2007? It was a popular new thing. They're just surging in popularity. Their sales are growing 50, 100% a quarter. Maybe for Apple, it was, when the iPhone first came out and the AirPods came out, something is going on with that company. They have a new product, a new service. Maybe if it's a solar energy company and the whole country's piling billions of dollars into solar, some catalyst is there, and it's going to make it a hot stock. All the hot stocks you hear about, it's when they're in stage 2. This is where you want to own. It breaks out, demand increases. And this is known as the markup phase, where institutions will continue to buy. And you notice they're kind of supporting the stock price. If you look in that green box, there really was no bad time, no bad place to buy the stock. Even if your timing was very poor, the market would have sort of bailed you out of this. So if you bought at 200 or 240 or 300 or 320, you've got the momentum of the market. And while the stock's being marked up and while investors are piling in and demand is increasing, they're propping up and supporting that stock price. If it comes down 5 or 6%, they're buying. If it comes down 10%, they're buying heavy. So normally during stage 2, you won't see any large pullbacks. In a proper stage 2 like this one, the stock should just ride its 50-day moving average all the way up. And in this case, it broke out here at, call it 167-ish and ran up here to 481. So stock ran about 187% in just, 5.5, 6 months. So the stock tripled in 6 months. These are the kind of moves you want to be in on. Now, eventually, all good things must come to an end, and that's where stage 3 sets in. Stage 3, these institutions have built positions. They've been buying the stocks at 100, 160, maybe 200, 220. Well, it's just a paper profit until they sell. And eventually, it's going to reach parity. It's going to reach the value they see, or it's going to get extended beyond what a reasonable person would assume this stock is worth, and institutions will begin selling. Stage 3 is probably the hardest to spot, but when you see it, if you take that warning and know this stock is no longer in demand, it's not what I want to target, you will be out of this stock for years until it comes back and forms a new stage 2. Generally, the tip-off for stage 3 for me is going to be something like this, like the largest down week since the beginning of the move. So notice how smooth the stock was riding up, no big pullbacks, and then wham, stock comes down 30% in 2 weeks. That's your warning right there. That's institutional selling when that happens, because it's not retail guys. It's not small fries like us selling the stock. For a multi-billion-dollar company like this to fall 30% in 2 weeks, it is large institutional selling. They're just dumping it. They don't care. They're getting out while they're getting good, and they're dumping it. Now, in this case, the stock pulled back and then came back up. Sometimes it does. Oftentimes it does not. But you want to look for this big break, and it'll be generally a big down week, a couple big down weeks. And the behavior of the stock will change. It'll just go from being very smooth and grinding to a big halt down this way. This is the beginning of the end. And this is honestly where most traders I see screw up the most, because what have you been taught? If you're on social media, what's social media telling people to do when this happens? What are they saying? BTD, right? They're saying buy the dip. Oh, it's 480. Now it's 300. What a deal. All stocks continue to go up. Buy the dip. And that's what most people do. And for a couple of weeks, they're going to feel pretty smart. Like I said, sometimes you get this extended push up here as retail piles in. Oftentimes you don't, it'll just capitulate. But this little warning right here is what tells you the party is over. And eventually, once the institutions are fully out, people buying the stock now are retail investors, folks like you and me, regular everyday people buying a stock who don't have multi-billion-dollar accounts, and it begins to fall. And there's no institution supporting the stock anymore. They're no longer actively buying it. There's no demand. And because there's no demand, you're just left with the Reddit crowd and the diamond hands and people who think they're smarter than the market and are buying because it's cheap. And eventually those diamond hands will break. And the stock will hit an uncle point, and then someone else's uncle point, and someone else's uncle point. And every time it does, or stop loss or whatever it is, you're going to sell. And that sell is going to continue to drive the stock lower. And with no one buying, with no demand for the stock, it will continue to capitulate lower until it finally bottoms out, becomes a stock that is, a quote value stock, or is fundamentally cheap based on someone's analysis of it. They'll begin buying, they'll build long-term positions, it'll form a new stage 1, and this whole process will repeat itself. General rules: only buy stocks that are in stage 2. And if you're looking to sell stocks short or bet against them or bet them to go lower, only short stocks that are in stage 4. because nowhere in the green box could you have bought and had a bad time. But there's nowhere in the red box in stage 4 you could have bought and made money. And the mistake people get into is, well, it's already down 50% or it's down 70%. How much lower can it go? 100%. I don't care if you pay $400 a share or $4 a share. The low is 0 and it can go to 100. And people look at this and, this thing, oh, man, you bought it at 460, say. I got it at half that. I got it down at 230. I'm so much smarter. Well, now looking back, the guy got it at 460 is down 85%. You who bought it at what you thought was half off, you're still down 73%. So I don't think being down 73% versus down 85% is much of a brag point. And the fact is, every stock that is going down should be off your watch list. It's off your radar. If you're trying to play some kind of fundamental and judge what the company's worth, not only is that difficult to do, you're having to forecast years and years in the future of projected cash flows and earnings, discount that forward, assume what the risk-free interest rate is going to be, all to put it into some sort of calculation, determine a fair stock price. And then you're sitting on your hands for years, hoping the market eventually realizes you're right, assuming all those inputs you came up with are right. So this is the trap for value investors. It's really stage 4. And the problem with buying the dip or buying on the way down is it only gets more attractive. If you thought the stock was a deal at 300, you're going to think it's a great deal at 200. You're going to think it's a steal at 100. You're going to be mortgaging your house at 60. And eventually you're going to be all in on a stock and up to your eyeballs in red numbers and losses. So the trick to this, the trick to having better success in the market, putting the odds in your favor, is simply sticking to stocks that are in stage 2. Now, is it possible you bought up here at the top of stage 2 and then it crashed and it stopped out? Absolutely. That's possible, but it can happen once. Any other time you bought in here, you've done very well with your position in that stock. Now, we obviously want to find low risk entry points. We can cover that at another point, how I kind of look for compression and volatility and tightening price and volume drying up and all those things that typically will lead to a breakout in the stock price. But this is the big picture flow of how stocks move and what the underpinnings are taking place in the market. Now, is there any questions on this before we go? I don't want to drive into this too hard, but this is really, really important to see. And once you see this and once you understand this, it makes a whole lot of sense why I'm so comfortable buying stocks at or making new highs and why I have no interest buying stocks that are coming down or cheap or pulling back. Because anywhere in here, this looked cheap. Now it's cheaper and cheaper and cheaper and cheaper and cheaper and cheaper. And listen, don't fall into the trap of going, wow, but it's XYZ stock. You don't want to go far. Well, it's Apple or it's Google. Look, PayPal's a great company. They fell 70+% this year. I mean, my whole family's on Netflix 8 hours a day inside the house. It's a great stock. We all give them plenty of money, but the stock's fallen 75% this year. So regardless of how good the company, how good their product or service, you simply don't want to buy it when it's not in demand. So all this is about following the funds, following the big institutions, and just sort of piggybacking their actions, using the chart to interpret what's going on. Is it in demand? Are they buying it or is it not? Or they're dumping it. I like to say, if they want it, I want it. If they don't want it, I don't want it. And you can fight the market. You can say, oh, they're wrong. Goldman Sachs is wrong. And this Notre Dame endowment fund's wrong. And all these hedge funds are wrong. And it's really this. Maybe let's assume you're right. Let's assume you've outsmarted teams of MBAs and thousands of years of Wall Street. Let's assume you have. It still doesn't matter. It's still, the stock is still going to go up or down based on its perception of value, based on the demand in the market, based on how much people want it. Do not make the mistake of thinking, oh, it's trading at this and this much earnings, and I've got a stake in this, and you're trading a piece of paper. And at the end of the day, that's all it is. It's worth what somebody else will pay for it. So I would far rather buy a company that makes no money and is in a strong stage 2 than I would a great company who's dripping in billions in cash flow in a clean stage 4. Now, really quickly before I go, I'll give you my rules for stage 2, because a lot of times people come in and say, Well, that's great in hindsight. Sure, it's easy to see it was stage 2 then. How did you know at the time? How did you know that it was in stage 2? It was time to buy. Well, I've got a set of rules for that, and I'm going to show you what those are. So first of all, I'll type these on the page. Hold on. So these are the guidelines for a stage 2 uptrend. The things we need to see. The 200-day SMA, or simple moving average, going up for at least 1 month. The 50-day simple moving average must be above 200-day. Stock price must be above the 50 and above the 200. And then stock must be at least 30% above its 52-week low, right? These are the rules. These are the defining characteristics of a stock in stage 2. Once these are met, I begin looking for a place to buy the stock. So if we go to the chart, let's just look at another one. Let's look at Crocs, for example. So here's Crocs on a weekly chart. Now I can very quickly tell you where these stages were. Very quickly tell you, this is stage 1. I would argue stage 2 goes to about right there. Say this was your warning window for stage 3. And then the stock capitulated down in stage 4. This is very rough. I realize that. But I just know it based on the guidelines. So what are my rules for stage 2? Well, break them down here. Let's look at what the stock was. What are we waiting to see? We want to see the 200-day moving average. That's this white line. You just see it rising for at least 1 month. So let's look at the 200-day. Up and then flat, 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 up, starts to rise. Okay, so it started to rise right in here. Zoom in a little bit. See how it's finally turned up? The 200-day moving average is now trending higher. Okay, I need the 50, which is the red line, above the 200. So that's it right here. That's the 50. And this is the 200. Now it's above it. Okay, I need the stock above the 50. It is. I need at least 30% off the lows, and it's 430% off the lows. That's definitely going to qualify. So this is when a stock entered into stage 2, right in here. Right in here. And you don't have to get the day down to the day, but for the most part, that's when we entered stage 2. So now you begin looking for an entry point. And look what the stock did from there. Ran 365% of the next year and a half. So really quickly, I mean, just want to see them stack. Stock, 50-day, 200 in that order, 200 pointing up, and are we at least 30% above the low? The stock's got to rally first. It's not going to start at stage 2 off the bottom. I'm not bottom fishing. I'm not trying to get a stock at the absolute lows. I'm letting it prove itself that it's in demand, it is now rising, and then looking for an entry point. And you had a couple of nice little entry points right in here. This little tightening over here, nice little base formed right over here for the breakout, several opportunities. Then we get this, then we get the big drop. Stock falls, 22% in a month. This would cause me warning. Let's see. Wasn't really on a lot of volume, but then you got this one in here. You had 1, 2, 3, 4, 5 weeks down in a row, 6 weeks down in a row, right in here. That's letting you know it's no longer demand. Volume is picking up on the selling right there, these 2 weeks. So maybe that's beginning of stage 3. Maybe it's here. Either way, when you start seeing this, that's your warning. Hey, institutions are dumping the stock. They're getting out. And always watch the volume, because big selling will occur. They can't hide the big volume. And that's that right in there, you see. So as you saw that, again, look at the behavior. This is pretty smooth, limited pullbacks. Let's get a little choppy there. And in this, that's a change in behavior. There's no longer a smooth ride higher. See how the stock, as I mentioned before, is riding this 50-day moving average all the way up, and then it just violently breaks it. That's letting you know the party's over. And we're never going to buy the low and get out of the absolute high. But I mean, even grabbing the stock in here and selling it in here, that couple of month period right there, I mean, that'll give you a 35% gain in just, what is that, 8 weeks or so. You don't need to catch the whole move. But sure enough, once this has been identified that institutions are selling, the big 5-6 down weeks in a row, big drops on big volume, they just, now, hey, this is not a stock I should be interested in. I mean, they're going to look to short this stock. I'm just going to stay away. Hell, there's 6,000 publicly traded stocks. I don't need to own all of them. I'm just looking for 5 or 10 good ones. And sure enough, some people bought the dip here and they go, oh, it's going to bounce up to 200. And they bought it and stayed here for a few weeks. And then it absolutely crapped the bed. And the stock fell again. So in total, it came down 73%. Even from here, it fell another 60%. So this is the 4 stages of the stock cycle. And as you can see, these small hints can save and make you a lot of money simply by looking at where the stock is in its life cycle, who's in control, is it in demand, is it being bought, is there lots of supply, is the stock being dumped in mass, and just get out of the way when they're selling and do everything you can to get in on the action when they're buying. All right. So that's the 4 stages of the stock cycle. If you want to learn more about this, I run a service called Stealth Trades, and we cover this in depth every single Monday in a live session. Every Monday at 1:00 p.m. Eastern time, we have a live Zoom call with my Stealth members and I. We not only go over this stuff, we look at I give my 3 favorite stocks each week with precisely where I'm looking to buy, where I'm looking to sell, where I'm putting a low risk stop loss. Look at the stocks you'd like to see. And I'm going to go much more in depth. So not only finding stage 2 is the first piece of this puzzle. Just focusing your efforts on stocks in stage 2 is going to dramatically improve your results in the stock market. But we take it a step further by dialing in to identify super precise, low risk, high reward entry points on stocks. We never risk more than 8 to 9% on any stock. And we're buying at places where the stock has a highest likelihood of making an explosive move higher in a very short amount of time. So putting everything in our favor. We're focusing on stage 2. We're looking at the areas of the market that are showing the most strength. Right now, it's biotechs and solar and healthcare, that kind of thing. And then we're finding the best stocks of those and looking for those low risk entry points. We're kind of taking a top down approach and finding the best of the best and trying to identify places we can risk very little, make a lot, and again, just put all the odds in our favor. So if you're interested in doing that, click the link below this video. It'll take you to a sign up page. We got a super deal. It's like $5 to join us, which is just enough money basically to cover the software and support staff if you guys need any help along the way. But I hope you join. I look forward to working with you. And my goal, as always, is to make you a more educated, more result-driven trader and investor. I want to show you how to risk less. I want to show you how to make more. I want to show you how to get out of the market when you don't need to be in the market, and when times are great, to really press it and just make you a more well-rounded trader and investor. So I hope you'll join us for the live sessions. We also send live trade picks out a couple times a month with that as well, that we track internals, a lot of education material inside the members area, and you can join for just $5. So click the link below this video and look forward to seeing you in an upcoming live session.